Welcome to Global Investment Insights, a weekly podcast brought to you by ADCB Asset Management. My name is Kishore Muktinutalapati, Head of Investment Strategy. With an objective to empower you with investment insights, on this program we discuss various perspectives that are shaping the global investment landscape. Last week saw S&P 500 Banks Equity Index lose circa 12%, the largest weekly loss outside the episodes of the global financial crisis of 2008-2009 and the COVID-19 sell-off during 2020. As a result of this, Asian and European bank stocks wobbled too, indicating a fear of contagion. In the bond market, where the reaction has been far more contained, regional banks underperformed the broader index. Large US banks were better behaved relative to their equities. Behind the rise in concerns of a contagion was the rapid failing of a mid-sized bank in the US. Silicon Valley Bank, SVB, announced last week that it would sell some of its fixed income securities at huge loss and raise additional capital through equity, private placement, and preferred stock. This unfolded as the bank's clients, who tend to be companies backed by venture capital, withdrew deposits at a rapid clip. The bank also guided the market towards a sharper decline in net interest income. However, eventually, as the bank was not able to raise capital as required, California regulator closed SVB on March 10th, making it the first bank failure since 2020, the biggest since the global financial crisis, and the second largest in US history. Adding to these concerns were the issues surrounding cryptocurrency-exposed Silvergate Capital, which voluntarily liquidated last week too. Now the question is if this episode is a prelude to another global financial crisis. While it may be too early to tell, based on the current information, we don't think that this is another global financial crisis in making. In other words, we view this episode as an idiosyncratic problem more than a systemic risk at this juncture. The post-global financial crisis regulatory environment was rather tight for the large US banks, thereby reducing the chances of a capital or liquidity event driven by asset liability mismatches or concentrated positions on security portfolios. However, the current episode does point to some near-term implications for businesses and financial markets. For the bank sector overall, higher deposit rates may be coming in the US as banks compete for funds. Banks with diversified funding mix are likely to do well compared to those with concentrated sources of funding. Mid and small-sized regional banks across the US may come under scrutiny over the next days as markets question what's next. Implications for the tech sector could be negative if the closure of the SVB is not handled smoothly by regulators. This episode also shows the disruption that's likely to occur in private markets, where unlike in the public listed markets, prices have not yet adjusted fully to reflect the higher interest rates. In the equity space, markets may move to assign higher risk premium to stocks of lenders that are tech-focused and crypto-focused. Also, regional banks could come under further pressure. In the market capitalization weighted equity indices, the representation of the regional banks is low. This minimizes the risk of contagion. In the US investment grade credit, the risk of contagion from small to large banks is remote, considering the low share of regional banks in the investment grade credit index. While the banking sector does make up a large share of the USD IG market at 25% of the notional outstanding, regional domestic banks only make up 6% of the bank sector, or about 1.5% of the broader USD investment grade credit market. Even that small weight is not very concentrated. The more significant market implication of this event may be through the Federal Reserve policy. With some risk to financial stability building, the Federal Reserve may not be able to pursue a very hawkish policy for very long. In summary, while we don't think the recent collapse of a mid-sized US bank is a systemic risk or a prelude to another global financial crisis, we think investors need to be mindful of certain implications of this event. We will watch the situation carefully and will keep our clients updated. Thanks for listening. We hope you found this podcast useful. If you did, please do share this and other episodes with family, friends, and colleagues. For more information, please reach out to your contact at ADCB. You can also log on to our website at www.adcbam.com. My name is Kishore Muktinutalapati, and I'll be back next week with another episode of Global Investment Insights.